Hi, this is Sam Roki at Ash Brokerage. Hey, really excited to share some news with you today. We're going to talk a little bit about taxes in January this year, and one of the reasons is we're seeing a shift in our political climate, right? And so we think that our advisors need to be preparing their clients today for what we think are going to be higher tax rates in the future. And so up here on your screen, I've got a graphic for you. And these are some high-level proposed items that the current administration or the soon-to-be current administration has rolled out as their tentative tax plan. And this is going to be really important for any financial planner. $3.5 million estate tax exemption could mean that a lot more folks are going to have estate tax liabilities. Potentially no step up in cost basis could actually result in a double tax. That is going to make insurance for estate planning purposes just incredibly relevant. We're seeing a possibility of a top marginal tax increase to 39.6%, which is kind of where taxes used to be prior to the Trump tax cuts. This is going to be really significant for your highest income earners, with those over $1 million AGI seeing a capital gains and long-term capital, qualified dividend increase to 39.6%. Plus the 20, or from the 20% that it currently is. What's interesting about this is that they'd also add the 3.8% surtax for Medicare, which would get them up over 42, 43%. And then the last piece for your business owners of pass-through businesses, they most likely income over $400,000 a year will be losing their Section 199A deduction. So there's some really interesting applications to both of these things. We are going to go into this in a lot more detail in our January 19th webinar. So please tune in, register for that. But there are going to be two separate opportunities I see. Number one is estate planning opportunities. So I mentioned it at the start. We're going to see a lot of discussion around exemptions. There's going to probably be a use it or lose it for your wealthiest clients. Low interest rates right now lend themselves to a ton of great strategies that work really well in this environment, including GRATs, split dollar, intentionally defective grantor trusts. And then there are some ways to maybe offset possibility of losing the step-up basis for estate planning, like the soon-to-be president has discussed. Income tax planning is also going to be really important here, because as we see tax rates increase, the tax deferral and possibly tax-free distributions from a life insurance policy are going to be huge. And so what we're talking about this year is what we're calling tax diversification. So we don't really know what tax rates are going to be way out into the future. So we think clients should be diversified. They should have some assets in a taxable bucket, maybe tax managed, tax deferred like traditional IRA or traditional 401k, but then also have a tax-free bucket, which is Roth-like assets, and life insurance as a Roth-like asset. If you like this video, please click the thumbs up button and feel free to subscribe for future videos just like this.